Welcome back, everyone. Let's share some tax knowledge. Today's video is about dispelling the myth that having a company is going to save you on tax, because that's not always necessarily the case. There are 6 reasons why a company might not be the best tax saving strategy. The first reason why a company might not be the best for you is because you receive what's called PSI, and therefore you're a PSB. This means personal services income and personal services business. This is where someone like a lawyer or an IT professional is the only person working in the company, and they are the one who are generating all the income. So they're being paid for their skills and for their labor. When this is the case, all the income or the profit that remains in the company must be transferred out of the company and attributed to the person in their individual tax return. This means they will be taxed at individual marginal tax rates, not the 25% company tax rate. Reason number 2 is taking out a loan from the company. This means that you're effectively taking profits out of the company, and if the profits taken out are not Division 7A compliant, then you're going to be taxed on that profit, and it's going to be a deemed dividend and an unfranked dividend at that, which means you don't get the benefit of the tax paid by the company flowing through to your individual name, meaning higher tax for you. We'll cover Division 7A in depth in another video, so make sure you're following and you're hitting that like button to receive notifications of future videos. Reason number 3, if you are not paying yourself salaries and wages income, where in your individual level, it's not effective tax rate of 25%, then you are leaving these amounts in the company, and these retained profits will accumulate more and more in the company. And when you need to pull them out, you might just be hitting that 47% and higher tax rate in your individual level. So the best thing for you to do, if you have a lower tax rate than the company tax rate of 25%, is for you to take out salaries and wages up to that 25% effective tax rate in your personal name. So that's just another reason why leaving funds in a company might not be the ideal thing for you. Reason number 4, and it's what we've already just touched up on slightly, which is if you leave retained profits in a company, it continues to grow. And when you need to take these funds out in one big go, then whatever entity that is receiving these funds is going to be taxed at a higher level. A company, at the end of the day, is a tax deferral strategy rather than a tax saving strategy, because it acts as a bucket, and eventually that water will need to leave or be taken out of that bucket to go into different buckets, which ultimately end up using those funds. Reason number 5. I don't know why, but so many people think that if they buy a car in a company, then effectively they'll be able to write off that car or fully depreciate that car. Someone didn't tell them about the logbook which they need to keep, which means they must determine what is the business usage percentage and what is the private percentage. The private percentage needs to be returned to the company via either a fringe benefits tax employee reimbursement, or only the business usage percentage is claimed through the expenses. So if you're going to set up a company, just because you think you're going to be entitled to more deductions than you would say at an individual level, that's not the case. Bad reasons to start a company. All right, here's the final one. Reason number 6. The company is not able to use the 50% 12-month CGT discount, which means any capital gain it has won't be reduced by a further 50%. The company might still be eligible for the small business entity capital gains tax concessions, but even when that is pumped out to the individual as a dividend, they're going to get taxed on that, subject to the 15-year exemption not applying. So as you can see, there are several reasons why a company is not the best structure to use, and it's not the best when it comes to safe tax. So you need to speak to a specialist, an accountant who will understand your particular situation and will guide you, give you the advice tailored for your unique circumstances. If you want, feel free to reach out to us and we'll have a chat to see how we can